Fun stuff. How's everyone doing out there? So, I'm going to talk a bit about what I'm watching in the markets here and go through some charts. On screen, we've got the S&P 500 futures. Just seeing a little bit of a pullback over the last 10 minutes here. Had a nice pop to start the day. As we can see, that cash open and really the first hour of trading lead to that nice little pop there. Does make you wonder a little bit, however. And so what I mean by that is, this energy that we saw in the first hour of trade, this is something I was talking about in navigating the markets over the weekend. And it was the idea that, we're in OPEX week. Today's expiration. It's really the last day of these flows. And these flows tend to be supportive. So this is sort of peak S&P put flow. We're seeing that decay from those puts really having a big impact here in that first hour. Now we're past that first hour and we're starting to see the other side of it, right? Right at that first hour mark at 10:30, it peaked. Now we see some distributive selling too. That big 1764 iceberg on top, that was some passive selling into strength. That was just right around ES 5000. You can see that volume, that session volume profile chunk there. So what does it tell us? It tells us that maybe we see a little bit of a resumption of pressure. We do see some liquidity building below us right around that warm put level. That's the second most active strike. Let me know if this is better here. Okay, so I think the biggest thing that I'm watching here is this continuation, this downside distribution that we're seeing after those put decay flows bid the market this morning. Now, there are other areas of interest as well. I'm looking at rates. We'll take a quick look over here at the 2 years. Not really a lot to go on here, however. Just a little bit of a bid here, bringing rates down. We've got a nice little rally in oil, right? We had this dip, and now we're seeing the resumption. So off those lows, looking pretty good. Gold trying to hold on to 2,000 in the front month, already having lost it in spot. Got a nice little bounce from below there earlier. And we've got the euro, which is still sort of just building a base here against the dollar, which is showing some signs of really breaking out. The dollar has been pretty incredible over the last, I would say, several weeks here, just pushing higher, and it's been a lot of weakness in other currencies. We saw the Australian dollar put in a head and shoulders early Feb. I talked about that on my Twitter feed a bit. And then there was that downside continuation into that pattern, which over the intermediate term, rather than the next 5 minutes, likely some room for continuation there. Now, we did have that hot CPI print yesterday. It did cause 10-year note yields to push quite a bit higher. I do think that's something that's worth watching, that breakout from that area where yields were sort of chopping in a range. If that continues, that could put some downside pressure on risk assets. I think the correlation between rates and equities here is pretty high. We do see some continued pressure. We also see some more resting bids developing below us. Typically, this acts a little bit magnetic. Trend is your friend, and this is the auction theory at work. Here are folks that are willing to buy, but they're willing to buy at lower prices. At this point, about 9 handles lower than where we're trading right now. And you see a little bit of a continuation of that downside move, just trading around that second most active put. And we see this other resting bid and others growing below 49.80, 49.75. You get a continuation of that pull. That was a pretty big stop there, about 591 contracts that were buyers of S&P at higher levels just got pushed out. We saw another stop like that just over here. So you are seeing a pretty decent amount, like negative 1,000. That means there was that 1,000 forced contracts stopped out, forced to sell. Take a look at some of the unusual options flows that are happening across the market here. Got some big buying happening in IWM. Lots of calls transacting there. Still a very bullish skew on IWM, so it does take a little bit more effort to really make things move, but worth watching that bullish sentiment. Folks are targeting all the way out to March. The 197s, the 202s, 199s for that March 15th OPEX. Several hundred thousands of premium going in there. You also see some hedging out there at SPY and NVIDIA ahead of earnings. Got several $100,000 for SPY. It's looking at the 15th of March, so some of that could be rolling of hedges for the 493 strike. But also for this Friday, 730 put on NVIDIA, about 107,000 in premium. But the big one that stands out here today, there's about 1.66 million in premium targeting the NVIDIA 705s on March 15th. So that is standout. That is a huge amount of premium there. Obviously, the implied volatility on NVIDIA options is really, really high. So it costs a lot to participate in that market. Maybe some of these folks are running multi-leg strategies as well to reduce that debit. But yeah, we do see this pull, on reasonable volume. You can see volume accelerating as we saw price moving lower here. There is a little bit of absorption here. You could see it briefly during that liquidity differential going positive. Buyers were trying to step in. You do see a little liquidity building above us. And we're just above where our Traderade options model calculates the gamma flip for SPX. And this is, again, all these levels on the right side are from SPX, but translated to S&P futures. Lots of buying in SMCI 970 calls, just about 800,000 in premium going into those for March 15th OPEX. So definitely seeing some position rolling and some other flows. SMCI call skew at one point was the highest on record. It did work that out just a little bit recently. Fed's Waller recently coming out saying guidance may have been too restrictive. And we did hear some updates from Israel saying there's no new proposal from Hamas and Cairo on the hostage deal, so no real de-escalation there. We've been hearing rumors about potential de-escalation for really weeks now, but no substance there, unfortunately. That does imply that there is probably a bid for oil underneath the market. That's one of the reasons it's probably making higher lows and higher highs here. Another big iceberg sell coming across here. 1,162 contracts, now 1,537. Let's take a look at our friend the NASDAQ. Tends to be a bit higher beta, right? Definitely seeing a bigger draw there too. And like the S&P, those flows did peak just around 10:30. And unlike the S&P, the NASDAQ doesn't tend to have quite as much liquidity on the book. You can see the total order book depth is just about 8,300 here. It's one reason it's a more volatile trading instrument. Take a look at the Russell here. Russell is quite volatile today. We're just going to zoom the timeline out a little bit here. Still more distribution in small caps overall. These things tend to be pretty rate sensitive, so not terribly surprising. We do see the 10-year bond yield coming down a bit today, down about 3 bips. After yesterday's big move higher, about 12 bips. So a little bit of sigh of relief there. But that move, again, as I was talking about, it did break out of a range for yields in the 10-year. So unless that was just exhaustive and it all reverses, that could be the start of a move higher in those yields over time. So that's one thing that we'll continue to watch, particularly in light of waiting for a government budget. The government budget that maybe one day we'll get. That is to say that the U.S. has been running on autopilot in terms of a budget for really since October 1st of 2023, when the U.S. government's fiscal year starts. Which is pretty incredible. Let's go back to the S&P now. We've got some changes here in the distribution of options volume. We've got more volume coming into this most active call strike. I think that's just about S&P 5,000 on cash. Just going to confirm. Yep, it sure is. So S&P 5,000 is the most active call strike. Just tweeted a chart of that out there for folks that are looking at that. If you're on the Discord, you can always see that right in the bot queries room, where you can query gamma profiles for any optionable stock or ETF. And that 0-day gamma profiling and volume for any stock and ETF is the next feature set I'll be building. We do see a little bit of liquidity continuing to build below us here. You can see that 569 bid coming in. Just around 49.60. That's just where the second most active put strike is, maybe a point below. And there is more overall put volume transacting. The CEO of Lyft is on Bloomberg now, probably trying to explain why that typo happened. If you didn't catch that, they projected their adjusted EBITDA margins, which whatever that is even supposed to mean in the grand scheme of things, we're going to expand by 500 bips. And then they later retracted that and said, no, we meant 50 bips. There was a typo. The stock at one point traded up 65% after hours, only to reverse a lot of that. Although today it's actually up about 31%. So, last night it went down from that up 65 to about up 14. And then today we're still seeing a pretty good amount of interest in the stock. Crude oil continuing to build after we got the inventory numbers, seeing a bit of a bid from those lows. NASDAQ looks a little precarious here. Let's see if we have any interesting liquidity. Not really a lot. And that iceberg we talked about earlier, it's about 3,000 on the sell side. Someone asks in the chat if I have any thoughts about Vixpiration and the window of weakness. So that's a great question. I do. I think that we enter that window really as of tomorrow. And if we look at seasonality, the second half of Feb tends to be pretty negative for stocks all around, whether it's the S&P, tech, primarily tech, you see more weakness, but it's really broad based. I think a lot of that has to do with options flow as well. So we're going into today with relatively elevated skew in the S&P 500. That helps to provide some of these passive flows that bid the market. We certainly saw that in the first hour of trading today. And then as that, hedging adjustment completes, you get more real price discovery, as it were, really after that first hour. And we're seeing some of that now. It's a choppier trade. So that might be a little bit of a preview. I do think that there is some chance, however, that if rates continue moving higher in that, what Jem Carson calls the window of weakness, where there isn't that implied passive bid for S&P from those decay flows, then that could be more meaningful because, we do see a stronger positive correlation with rates and equity price discovery of late. And I think that will matter if we see rates continue to build and move higher. Maybe there's stronger than expected economic data or inflation data or otherwise that catalyzes it. That could put more risk into the price discovery of equities. We could see more downside pressure. And I think that would be much more material during that period of time where those flows aren't there to kind of bid things up. Like yesterday into the close, that was one reason we had a nice little recovery into the close, is those same flows were helping to bid the market higher. So I think that if we take into context kind of what's helping to relieve the pressure and what's helping to drive prices higher, a component of that is vol selling and equity accumulation from those systematic funds. A component of it is CTAs buying momentum. A component of it is record flows from retail and corporate buybacks. But another component of it is that implied bid from S&P put decay, causing dealers to remove those hedges, which are or S&P futures shorts in part, and that creating a bid for the market. So one of those structural support mechanisms goes offline. You do have buybacks, though, in full effect. We're outside of the buyback window, so the biggest buyers of their own stock that are authorized to do so are now more free to move about the cabin, as it were. So I think that, could be a somewhat offsetting effect. But net, I would look for a second half of Feb and really through first half of March to be a bit choppier. And typically that is the case year over year. We see that tending to be a period where there's more volatility and there's more opportunity for corrections in time or price or both. So let me know if that helps. So Riot, more puts being purchased. It really, as they're being purchased, it's going to boost the VIX if skew is favoring puts, right? So when you see those big piles into puts and the VIX is moving inverse to the S&P, that usually is actually something that's going to build some vol. But then after that, if those flows don't continue, that is vol dampening, as is zero DTE, because you have more and more activity happening in shorter and shorter time frames. And it's not just zero DTE. About 75%, 80% of SPX options flows are happening with expirations of 3 days or less. So more and more people are transacting closer to price with shorter and shorter duration. That also has a vol dampening effect. And then you got vol sellers, probably with the most vol short positioning we've ever seen, also piling into that. So it's kind of like a convergence of different forces. So when the puts are being purchased, it's not dampening, but the side effect afterwards, as we approach OPEX, is vol dampening, that passive distributive flow. Well, yeah, the other thing that I would say, though, yesterday evening and then this morning is those puts are losing value. And as they lose value, market makers are hedging delta to be delta neutral most of the time. So as those puts lose value, they don't need to have as much S&P futures contracts on their book to hedge out those puts. So they can actually start buying those back, and that ends up being liquidity positive. And that you typically see that strongest in the first and last hour of trading. So it really has a lot to do with the context, right? I do think that yesterday we saw a very unusual amount of put spreads, bearish put spreads opened in the S&P 500 futures. And, I have alert set up to look at those block trades, and I had never seen a day quite like yesterday in terms of the amount of bearish put spreads. Now, these were all bearish put spreads that were opened to close the same day. So it was also like a huge flow of zero DTE bearish put spreads in the S&P futures. Very, very unusual, very interesting. I'm sure they made some good money on that, but not something you often see. Now we do seem to be consolidating, building a little bit of a base here. Let's see what the Nasdaq looks like. A bit weaker than the S&P. As I've said repeatedly, I really like to see the Nasdaq lead. So not seeing it show much strength here as the S&P is, kind of consolidating makes me think we might just move sideways to lower. We'll have to see. I really want to see the Nasdaq kind of lead the way. So let's watch that one as well. And we do have call interest still building at S&P 5000, which translates to ES about 5017. That liquidity below us, though, not really going away. Seems kind of steadfast. Let's see what else we have here on the heat map. Some of that liquidity that was lower actually moved higher by about 50 handles. So that's interesting. They're willing to pay a little bit more to either cover a short or open a position. Bank of England's Governor Bailey is saying inflation is coming down to their target by spring, and they have seen a pretty big slowdown. Remember, UK had some of the worst inflation in the developed world. Oil continuing to consolidate here after the EIA data showed 12 million inventory build versus about 3 million expected. Seeing some more relief in rates here. Some decent decent bid here in the 10-year note futures. That should give a boost to gold, and it more or less is up a couple bucks. And dropping rates should also help cross pairs with the dollar, particularly the euro, and we're seeing a little bit of a bid there. Those intermarket dynamics are so important to monitor. So we're back to the S&P. Cotton's been on a tear for anyone who's trading commodities. That has been an absolutely brutal uptrend. Similar with cocoa, which is taking just a bit of a breather today. And as we approach the lunch hour, things tend to get a little bit more thinly traded. Typically, you don't see really big moves, but when you do, it can catch participants off sides because it's more algos trading anything over lunchtime. A lot of folks just check out for an hour or two. If we zoom in really close here on this price structure, it still looks like consolidation here. I want to see a break of the top of this range to feel a little bit more optimistic about where we might go from here, particularly with a little bit of conviction, a little bit of volume, which would look like larger bubbles on this heat map here. So let's see if we get that. Early indications, seeing some liquidity building above us, which is good. See how our friend the NASDAQ is doing here, if it has a similar look. Somewhat. We'll zoom in a little bit so it's kind of comparable time frame. Yeah, pretty similar look between the two, right? So seeing that both are looking to try to put in a little bit of a bottom here and make a push. Now, looking at this, I would be wanting to see the NASDAQ cross above VWAP and point of control to get more excited, similar with the S&P. But so far, looking a little bit encouraging here. Seeing a little bit more of a push higher here. A little bit more volume coming into that push. We also see 10-year note providing some more relief in rates up here. Lots of central bank chatter all over the world today, particularly the Fed, the ECB, and the Bank of England to add a little volatility into our trading day. Just watching carefully, see if we can break VWAP and point of control on NASDAQ and S&P. That would have me looking at this a little bit more constructively for continuation. Let's see where we are with the options levels from the SPX options visualizer. We do still have volume building at SPX 5000. That is a really important level, by the way. That's the largest area of gamma positioning on the entire options chain. So probably be an area where we would expect some resistance to come in, as it did earlier today. Those bids below us also have not gone away, but we do see more liquidity appearing above us in the ES contract. So I'll be looking at this Gamma 4 level. That's the fourth largest level of gross gamma exposure as one area of resistance for the market to break above. We can see there's a lot of resting liquidity above us on the offer. So there are some folks looking to either get out of long positions there or enter short positions there. Just got a headline that Iranian officials said 2 explosions struck natural gas pipelines in the country early today, and they are calling the blast a terrorist attack, which comes amid heightened tensions in the Middle East over the Israel-Hamas war in Gaza. I would imagine that part of this is retribution for the attacks that Iran has sponsored with the Houthi rebels and otherwise with Hezbollah against the U.S. and its allies, so that's probably the other side of this. It's credible that this strike was attributable to the West. And that could give oil a little bit of, again, an extra oomph here because it is an escalation of geopolitical tensions. We do see a resting offer now building up at ES 5000 as we just test this gamma level 4, the fourth largest level of gross gamma exposure on the SPX option chain, translated to ES levels. Someone asks, natural gas is cheap, but could it get cheaper? I would say that natural gas is just, I've renamed it. I've renamed natural gas. It's now called natural crash. So I would preface my response with that. Of course, I'm having a little fun there, but it has been just absolutely brutalized. It's an interesting dichotomy in natural gas right now because February tends to be a pretty seasonally weak time of year. It has not been a very cold winter. And then you have the restriction of exports of LNG from Texas, where there is an oversupply of natural gas. That's all led natural gas at the benchmark Henry Hub natural gas lower because Henry Hub natural gas is essentially Louisiana, Texas natural gas pricing, right? That's the main contract we're all trading, down 4.20% today. I would say that, shorts are not incredibly aggressively short natural gas. We've definitely seen them more short here. There's more reasons. There's more supply and demand reasons for natural gas. And until LNG can be exported again, and until we see a real renaissance in the good producing component of the U.S., where there's a lot of natty or natural gas used for industrial purposes, I'm not so sure it catches that much of a bid, but I would say that March at least tends to be somewhat seasonally more positive. So let's take a look at that real quick. So I like to kind of go back to the beginning of the cycle. So I'll take this back to 2009. And so actually, let me restate that it's not actually March that tends to be better. It's really April. So March has a 40% chance of upside with an average gain of negative 0.2%. So March is not amazing. It's better than Feb, where it's only a 33% of upside, 33% chance of upside with an average loss of 4.7%. January, similar, 33% chance of upside, average loss of 5.7%. Now, once you get into April with natural gas, 87% chance of upside with an average gain of 7%. That is the seasonally best month of the year for natural gas going back to 2009. The second best month would be October with a 67% chance of upside, average gain of 5%, followed by August, 67% chance of upside with an average gain of 2.9%. So in terms of natural gas, we're entering a time that might be more seasonally constructive, particularly as we get past March. Hopefully that helps. I am not a buyer of natural gas here. I'm more interested in the companies that are providing services to natural gas companies, and then some of the best of breed oil and gas companies like Diamondback or Fang is one that's quite interesting. Liberty is another one that's interesting in the services space, LBRT. And S&P just continuing to consolidate in this range here, building a little bit of acceptance, but I'd really rather see it push above Gamma 4 and above point of control and VWAP. Got these three key levels right above us, hovering above as resistance. And I would like to see a break above to feel a little bit better about price action and getting long intraday. Let's take a look at the NASDAQ. NASDAQ looks slightly more constructive than the S&P here, but still need to see that push above VWAP and that point of control. VWAP in white, point of control in yellow here. Someone asked, what is holding the S&P and NASDAQ up? And I would say one of the things that has helped today is rates. Rates have been coming down. You can see that big bid in 10-year note futures helping to bring down rates, and that's easing some pressure on the market. So let's see how we react here. Are we going to be able to push above Gamma 4, where there's a large order just below it? Let's take a quick look at the Russell. Russell looks more constructive than the NASDAQ and the S&P here, pushing above the point of control and VWAP and continuing to build. Crude giving back some of those gains post EIA. But we're really just looking for how this area of consolidation is resolved. No reason to get aggressive long or short until we figure out what the market wants to do. The biggest mistake I see a lot of traders make is over trading, or getting too confident about their bias versus what price is telling you. And you can have opinions, it's fine. You can be bearish, but or you can be bullish, but wait for price to tell you and give you a confirmation before you trade on it. Have a setup, stick to the setup. Don't change your stops or, unless you're moving them higher into profit. Stick with your system. NASDAQ seeing just a little bit of a pull here. You got the point of control being pulled down into this area of consolidation, both in the NASDAQ, not yet in the S&P, but perhaps we'll see that because we have a similar pattern here. Someone asked a really interesting question. Could I discuss the liquidity dynamics between single stock and index options flows into options expiration? So I'll provide some information, some context, and then, if you have follow-up questions, I'm more than happy to discuss those as well. So when we talk about index options, most of what we're really talking about is just the S&P. The vast majority of index options trading, about 1.2 trillion of notional every day, is in the S&P 500 index options. Smaller than that is SPY. Smaller than that is S&P futures options. When we look at the S&P index as the sort of preeminent index options vehicle, it's primarily used for protection. So most of the time when people are transacting in S&P, they are transacting on the put side in the form of buying protection. And the reason they're buying protection is to reduce their value at risk, whether that's to increase buying power or to become more compliant with risk management. That's all up to the prerogative of the trading desk. But they're generally, and really 100% of the time since the 87 crash, skew, or the distribution between premium and calls and puts on the S&P 500 index has been on the put side. That is to say, there's been more demand for insurance than for upside exposure in the S&P for the better part of 40 years. And so that dynamic, as we go into OPEX, the higher the skew is, the larger the supportive flows you have from those puts losing value, right? So if you have a large amount of S&P puts leading into options expiration, that 2 weeks leading into OPEX is going to have ever increasing amount of those flows, those passive flows, as dealers are re-hedging their deltas. Because what a dealer, an options market maker, is doing is they're selling, or buying contracts depending on what side of the trade, the other party is on. So for the example of someone buying S&P puts, they're selling those puts to them, right? And to make sure that they're balanced on both sides of their book, that means they need to short some S&P 500 futures as one very common way they hedge. So as those options lose value, they don't need to have as many of those hedges on their books, which means they start buying them back. Those supportive flows tend to happen most in the first and last hour of the trading day, right? That delta and theta decay flow. And a bit overnight as well as the European session starts. Now, when we look at single stocks, it's a different dynamic altogether, because most single stock option skew is on the call side. There were some exceptions. The 2022 bear market, there was a lot of skew on the put side, which was one thing that was telling you, people were really getting scared, buying a lot more insurance, effectively kind of putting a bottom in, because markets don't tend to, draw down too violently when people are seeking protection in size. Well, that dynamic, of course, in 2023 and now this year has flipped back to call skew. And in fact, in some cases, that call skew is very extended. The implications of that are the exact opposite of the S&P 500 index. That is to say that you have dealers, when they're selling those call contracts, they're buying shares in the underlying. So, people are buying lots of NVIDIA calls, then the dealer is buying those shares commensurate with the delta they need to hedge. Now, if those NVIDIA calls lose value over time, as they approach expiration due to theta decay or price moving away from the strikes, then dealers are able to hedge less because that meets their delta hedging requirements to be flat. And that means they're selling shares. That's net distributive. That means it's putting pressure on the single stocks and ETFs where there's call skew and where that call skew is the heaviest. An example being Meta or Nvidia or Google, where call skew is really, really bullishly tilted. So that's the dichotomy. On the one hand, the indexes, as you approach OPEX, because especially in the S&P, it tends to be put skewed. That's supportive liquidity as dealers are adjusting their books and reducing their hedging. And the opposite is true of single stocks. That tends to be net negative of liquidity, particularly where call skew is the most disproportionately bullish. So let me know if that helps answer that question. And, I spoke that whole time and really nothing happened in the markets, just kind of continuing. NASDAQ looking a little bit more bullish than the S&P. You can see it's sort of trending higher here. But S&P, not as much, kind of just flat. Just pinging and ponging here. And today is Vixpiration, so happy Vixpiration. Coming on Valentine's Day, for everyone that celebrates both holidays. Hope it's festive for you all. Seeing a little bit of a pull in S&P. Let's see what the NASDAQ looks like. Similar look there. Someone asked, do you think we could see a pullback after OPEX as dealers need to sell hedges? So, to be clear, in single stocks, they're doing that right now, this week, right? They're reducing their hedges on the share side because when they were selling calls, if those calls lose value, particularly as they do on a day like yesterday, rapidly, dealers are going to be selling those shares that they took on as hedges, and that adds to some of that downside pressure. And we do see a big pull here in ES. I don't see any news crossing the wires, but we're down about 10 handles from that peak. So going back to the question, post-OPEX, I think the bigger reason you may see weakness is there's those lack of supportive flows for the S&P from that decay of puts, right? The dealer hedging dynamics change a lot, really after today. And so on the one hand, that single stock call skew will be less of a problem for liquidity in the more bullishly positioned stocks. But on the other side of it, and the much bigger component of options trading is the S&P, and those supportive flows, those Vanna and Charm flows, won't be nearly as prevalent after today. So I think that after today, that risk is magnified. And if there is a downside catalyst, it's more meaningful. It doesn't mean the market just automatically goes down on its own. But it does mean that there's what, Jem Carson and others have called a window of weakness, where there's a lack of those supportive flows to buffer downside. Let me know if that's helpful to contextualize your question. And yeah, great questions from everyone today. Really appreciate it. And hopefully this is helpful to everyone listening. I really love talking about this stuff. So another question coming in. If you don't mind a follow-up, is there a relationship between the applied correlation between S&P components and the index and the skew in the S&P? So to an extent, what you see, and hopefully this is addressing your question, but if not, feel free to follow up. But typically, what you see is much more put skew in the S&P index as a whole and much more call skew, particularly in the top 50 and most especially the top 5 S&P stocks, right? So you have folks hedging their long exposure with the entire index, but getting long, particularly some of the outperforming stocks in the index. This is especially true with hedge funds. So, correlation really depends on demand and supply. There's always this passive demand for S&P products because you've got a lot of folks that are buying these passive products. At this point, you've got 5 stocks in the S&P that make up about 26% of the market cap weighting. So that means every time you put a dollar in the S&P, 26 cents goes to those 5 stocks. So they're obviously going to see more benefit from passive allocation. They'll also see more of a deleterious effect from selling at the index level. Apparently, a headline just crossed about Uber and Lyft drivers striking around the country. I just heard this over audio. That's interesting. But yeah, I would say that correlations are within the broader S&P. When you have those passive flows and they're quite strong, like pre-OPEX, then a lot of the stuff tends to get bid together. But then you have to really look at the individual flows, like where are the call flows and where are the actual share accumulations happening. They tend to be the areas that are going to outperform. So even though you get a passive bid in the S&P, you're still going to have components that outperform based on supply and demand. If you contextualize the market and its components as an auction, there's 3 states that auction can be in. It's one of excess supply, where we're selling and we see price go down until that excess supply is alleviated. There's one of excess demand where the opposite is true, and then there's one of balance. And during that period of balance, you have corrections in time or consolidation. So let me know if that helps, and feel free to follow up if you have additional questions. I'm going to step away from the mic for just about a minute or two. I'll be right back.
Justice Scrapworkers Coalition says workers from Chicago, Miami, and Philadelphia are striking for livable wages and protections from deactivations. That's UBER and LYFT.
At 12 p.m. Eastern Time, we expect comments from ECB's Nagel, who joins a panel discussion on how will financing work in the future.
CETY, Clean Energy Technologies, now up 129% at the high at $1.23. CETY, and shares were halted again.
Take it all back, some way, somehow. If I knew back then what I know right now. Can we stop? Me, I'm not here. Can we stop? Me, I'm not here. Can we stop?
CETY, more highs now, $1.44 after resuming up 154%. That's Charlie Echo Tango Yankee.
At 12 p.m. Eastern Time, we expect comments from ECB's Nagel, who joins a panel discussion on how will financing work in the future.
All right, I'm back. See that not a whole lot has happened while I've been gone. All right, so I was asked if the S&P 500 continues to go lower, where would I be looking for potential downside targets? So let me do a little bit of quick charting here. I'm going to focus on the ES contract. That's where I primarily look at price action. So what I'm going to primarily focus on here is where there have been important decision points in the market. Because, obviously price is going to lead us. We have to kind of pay attention to what it's telling us to get a better sense as to where it may be going, who's favored by the prevalent trend. So I'm just marking up this chart of SPX, and I'm going to put it on screen. All right, here we go. Should be able to see my trading view on screen now, right? Here's ES, and these would be potential areas of downside to consider depending on how this all plays out. So 49, 41, 50 is a pretty decisive area. We tapped it yesterday, bounced from there. It's also a somewhat important area in the volume profile. We've been there before. Then we get 48.76 as another area of interest, and we can see why. It's an area where, again, the market has shown there's demand. It's also right where we get into a low volume node, which tends to be an area of decision in the volume profile. Then 47.69.50 would be another area I'd watch for similar reasons. It's been an area where, important price discovery has happened. We could probably even put another level just below it, around 47.50.50. And this is all in the March S&P 500 E-mini contract. That's about 17 points higher than SPX, right? And then we've got 46.38.25. There's some price action here where the market just kind of floated higher. Wasn't a lot of decision there, so that could be a somewhat vulnerable area. If we crack it, the point of control comes into view, and that's about 45.72. And then finally below that, 44.25.25. So I'd be looking at this more from the perspective of watching how we trade around these key levels. Like we can see the S&P has had no problem staying above this key 20-day moving average. And yesterday it actually bounced just right above there. So I wouldn't get too bearish on price action until we're able to break below that in 49.41.50. Then from there, I think we have a number of different downside targets we can look to depending on how aggressive the sell becomes. But for now, we're still pretty much in an uptrend. It's not a strong reason to get too bared up, near term, unless we crack that uptrend line as well, just in my own opinion. So I think that's going to be important. It may end up happening around the same time that we crack the moving average and crack 49.41.50 if that's to happen. But I would contextualize this all as like we're still not seeing enough distributed pressure to say there's been a trend change of yet. So hopefully that helps. Let me know if you have any follow-up questions on that. We can see there's some continuation here. S&P drawing down to one of those key levels of resting liquidity. We're going to zoom out a little bit. You can see interest in the hot put growing just around 49.68 on ES. We can also see that these resting bids are growing as the resting offers are shrinking. That's often a bearish sign, and we see confirmation in price. We also had the point of control pulled lower by this selling pressure. I'm just zooming way out. You can see there's a pretty large resting bid down here, around 47.75 or so. It's interesting. Don't think we get anywhere close to that today. But we'll have to see if that stays on the books. For now, we can see that the gamma flip level is a pretty important area for other market participants. They're watching it closely as well. And that's why we likely see this large resting bid just above that gamma flip level, calculated by our model. Let's take a look at the world of currencies and rates here. We're going to take a look at the yen first. It's been climbing today. Generally, a weak dollar is good for markets. Similar look with the euro, climbing. You've got the 10-year note providing some relief in rates. Let's see what our yellow metal friend is doing. Gold coming off its lows, breaking above the point of control here, looking pretty constructive there overall. Oil, however, just not too happy there. That's good for rates. Usually when oil comes down, it puts some pressure on rates to come down as well. And our most rate-sensitive trading instrument here, the Russell 2000, full of over 40% of companies in the index not making any money at all. Well, it's rolling over, even though rates are providing some relief. So that's not a great sign, that relative weakness in the Russell. Moving back to the S&P, we are just above that gamma flip level in the 49.75 resting offer of 436 contracts. Resting bid, my apologies. Getting a little bit of a bounce off that level. And that's always interesting to contextualize. If you get a meaningful bounce from a large area like a resting bid like this, and it actually starts to move against it, and then the bid starts to fade, that can be bullish. We haven't seen that play out yet. Right now, this is just a little pop. But I just like to add that info because folks out there that are trying to learn, how does Bookmap work? What am I seeing on my screen? I want to make sure that this is adding some value to your trading experience and education. Yeah, you're welcome. Thanks for the question. And so to contextualize what this gamma flip level means that you're seeing on screen on the right side, that is how our naive model calculates where we flip into negative gamma territory. So moving below ES 49.75 would indicate that SPX is pushing into negative gamma territory. In negative gamma territory, you see rips bought and dips sold into, so it tends to be a volatility catalyst. NASDAQ, similar look as the S&P, drawdown and then starting to base a little bit here. Russell continues to fall, however. And S&P now taking out that resting bid and moving lower, testing that gamma flip level. We do see a large resting offer just above us here. But we also see that resting bid below around 49.61 actually growing. This is why I was a little cautious earlier saying that, we need to wait for the market to tell us it's ready to move higher by moving above the point of control in VWAP and that gamma 4 level. Now we can see VWAP is right at gamma 4. But we never moved above. We never got that bullish sign. And so that was why I didn't want to get long, because I never saw anything telling me it's time to get long. And in fact, when you see a situation like that where there are encouraging signs and then it rolls over, that can be somewhat bearish, and you generally get buyers that are trapped and become motivated sellers at lower prices. So this area here where there was a large amount of buying around ES 5000, and then also here around 49.85, all those buyers, assuming they were buying to open, and even right here at Gamma 4, about 2,700 contracts, they're on the wrong side of the trade now, right? So any of those folks that weren't covering shorts but were actually entering new positions at these large areas of session volume profile buying, price has gone against them. So they become a little bit more motivated to potentially sell into it. And that might be one of the reasons you see a little bit more pressure as you get away from those levels. Let's take a look at what's going on in the world of equity options. More bullish flows into SMCI 860 calls for March 1st and March 15th. A total of 723,000 in premium spent on those. But the largest transaction today has been that NVIDIA put, which may have been a hedge. That was a pretty significant size there. It was about 1.6 million for the 705 strike for March 15th on the put side. Of course, we did have a lot of bullish flows in NVIDIA too. The 730s and 735s for this Friday. Someone piled in with about 1.1 million of call premium there. And really, wow, someone's getting really excited about SMCI for next week, piling into the 1,000 strike calls with 250,000 in premium, and then the 1,200 strike calls for March 15th with 360,000 in premium. Pretty incredible stuff there. That stock has just gone straight up and just it doesn't seem to take a pause. At one point, skew on that stock was the most blown out to the call side I'd ever seen. We have corrected that a little bit, particularly after yesterday. Someone asks, how do I think the NVIDIA earnings call will play out post-earnings for the market? Feels like it's the most anticipated earnings that I've ever seen. It's a very interesting question. I think that expectations are very, very high. And, they should be high. This is a company that's delivered some of the most impressive earnings growth, we've ever seen in such a short amount of time. And a lot of that has to do with the H100 being immensely profitable. It costs them about $3,200 to make one of these things. They're selling them for 30 grand and up. The aftermarket, you can find them for 40 grand all the way up to 95 grand. So there's obviously demand for these chips, for this technology. On the other side of it, however, we are seeing signs that competition may finally be starting to increase. AMD has open sourced a platform that allows folks with AMD hardware to run NVIDIA compiled binaries for NVIDIA hardware. And one of the biggest sticking points for NVIDIA was the exclusivity of their CUDA ecology, the ability for NVIDIA to really lock folks in because there wasn't a viable alternative. That seems to be in the early stages of changing. I'm not sure if that will materially affect their outlook, but it's certainly something to take into consideration in light of what all is being priced in for NVIDIA moving forward. Now, I would look at this more as context is king. If NVIDIA comes in and they're able to handily beat investor expectations, and they surprise the market to the upside with more, really, really optimistic guidance, then I think the stock could continue moving higher. I don't think there's any reason it wouldn't, because this is a euphoria. There are in the AI world, the sellers of picks and shovels like NVIDIA, Microsoft, Palantir, SMCI, and then there are the companies that are trying to mine for the gold, right? It's a lot like the gold rush in that sense. So NVIDIA is at the top of that, and I think they're benefiting from it handsomely. Now, as competition increases, so when we look at this from the context of what does it mean for NVIDIA's earnings, I think that there's three main scenarios that can play out. It's a bit axiomatic, but basically well in excess of expectations, and this thing probably flies, right? Because there are still folks that are probably being pestered by their investors that the funds don't have enough of, if any, allocation to NVIDIA, right? Never mind the fact that it's a huge weighting in every passive index, right? Every market cap weighting index like the NASDAQ and the S&P. So I think there's a scenario where they surprise to the upside and continue getting bid. I think there's also another scenario where they're projecting growth that doesn't meet what the market is pricing in, and the stock gets a pretty considerable drawdown. And because it's one of the Magnificent Five, and that's such an important part of the market, that could lead to a broader downturn for NASDAQ stocks, because AI is a really big part of the implicit bid in this market. It's the story, it's the narrative, it's the idea that AI can, deliver all of these returns in the present. Now, in most of these technological hype cycles, you have future returns being pulled into the present, right? This is a time and time again situation that we've seen, and that is true in some of this AI as well. There are, years of future returns being pulled into the present. So the bar is very, very high for these things to continue to perform. And I think that if on the other side of it, you see guidance that doesn't meet market expectations, because I'm not really too concerned about earnings from NVIDIA, I'd be more concerned about guidance, there could be a pretty strong negative reaction, and that could be a powerful negative catalyst for the broader market, because a lot of this rally has been concentrated in this theme. So those are the two sides of the story, I'd say. There's a side where NVIDIA can rally really hard. There's a side where it can sell off. And maybe there's also a scenario, less likely one, because of how extreme positioning is, where it's just sort of flat, where the market's like, okay, this is kind of what we were pricing in. We're not going to really do a whole lot here. So I think it's going to be a really important earnings release. It's going to be one that the entire market is watching, and I would imagine that it'll have an effect on price discovery for the next week or two for NVIDIA and many of the other stocks in that ecosystem, for SMCI, for Microsoft, for Palantir, and others, because it's really looked at as a benchmark for AI. Let me know if that's helpful. Someone in the stream said that they follow me from Saudi Arabia and asked me to put in a translation. Boy, I wish it was easier to do that. I really do. If there was a automatic way for me to translate in real time, I'd be all over that. And if someone knows and wants to shoot me an email or a message and let me know how I could do that, I'm all for it. I just don't want it to be like the automatic subtitles on Google where it's like, you know, it's saying like completely different things than what you're saying. You saw that 628 offer up here at 5,000 where there was all that transacting and just got pulled. Looks a bit like a spoof to me. That should not just disappear from the books completely. And that is technically illegal if it was a spoof. I know a lot of this stuff is algo driven, so that's probably how they get away with it, but it is always interesting to see this stuff. We got S&P challenging the point of control that's been pulled lower by selling from below here. It's also a pretty important area because you got some of these buyers that were transacting in size at 49.85.
Whiskey Lima Oscar.
I'm just feeling celebration tonight. Celebrate, don't wait too late. No, we don't stop. You can't stop. We're gonna celebrate one more time. One more time. One more time. A celebration. You know we're gonna do it right tonight. Hey, just feel it. Music's got me feeling the need. Yeah. Come on. All right. We're gonna celebrate one more time. Celebrate and dance so free. Music's got me feeling so
Little
free.
musical interlude there for fun.
Celebrate and dance so free. One more time. Music's got me feeling so free. We're gonna celebrate.
But let's get back to the business of doing business in this market that's trying to decide what it wants to do. We'll take a look at the NASDAQ here as well. Similar look. It's kind of hovering below that point of control. Russell actually breaking above VWAP in the point of control again. Last time was a bit of a head fake. Got crude oil here making a new low and possibly another lower high. 10-year note providing a little more relief in long end rates. And gold building a base after its recent lows. On the S&P, it looks like that 49.85 level where there was some aggressive buying and the point of control has been dragged down to is providing a little bit of resistance here. ECB's Nagel saying the German economy may have contracted in the first quarter of 2024, adding there's a lot to do on Germany's economy. The ECB will likely be the central bank that cuts before the Fed or even the Bank of England. They have a much more rate-sensitive economy, and there's more risk in their financial system. Lagarde can talk tough all she wants, but the reality is one we're all aware of.
Breaking me down. Don't know what I should do when you come around. I'm leaving without your love.
Let's take a look around, see if there's any interesting stories brewing here. Not too much going on out there, really, that we haven't either already talked about or isn't well known. And we just continue to sort of build volume again right around this point of control, right around this area where market participants have wanted to transact around 49.85 ES. Yeah, Will, there's not much that can be done about that. That has more to do with their platform than anything I can do on my end. So if we're really going to see this thing get a better bid, I would like to see us break above VWAP here and build some acceptance and then start to push higher. And then we've got some targets up here with the second most active call, the warm call, and the hot call, where price could push. On the other side of this, however, if we break down from here, this hot put, warm put level, and then right below the warm put, this 574 contracts on the bid would be reasonable downside targets. So we have our kind of distribution of potential outcomes. We're waiting for price to give us some sign as to whether it wants to do anything.
RAYA resuming now, following a circuit breaker halt. Romeo Alpha Yankee Alpha, RAYA. $1.36 now the high on RAYA. React Power Solution Group. That's the ER. That's RAYA, Romeo Alpha Yankee Alpha.
Getting a little bit of a bid here in S&P. And we're looking at gamma 3 here, and the VWAP level is really that most important pivot here intraday. So someone asks, could you elaborate how you obtain market implied probabilities and how you've used this information to make profitable trades? It's an interesting question. The area that I focus the most on market implied probabilities is Fed funds futures. And I would say that I look at Fed funds futures because, and I wrote a thread about this, I think it's an interesting topic. They aren't supposed to predict the future. They've never been meant for that, and I know a lot of folks kind of mischaracterize it and look at it as if, oh, they're always wrong, except for like the week ahead of the decision. And I get it, but that's not how they're used. And so I look at Fed funds futures as, like you're talking about, market implied probabilities. These are the expectations of the market. And so when those probabilities shift, you tend to see re-ratings in other related markets, right? So, for example, with yesterday's CPI data, we had a re-rating in Fed funds futures, moving out the implied probability of the first cut from June to July. That helped to send rates surging, the 2-year, the 10-year, the 30, the two being the most important for watching Fed funds expectations in the U.S. Treasury complex. And so I think when the market was expecting 5 or 6 cuts, and for them to happen as early as March and then May and then June, and that keeps getting pushed off into the future, and we see upward pressure in rates in multiple parts of the yield curve, the probabilistic outcome that was being priced in versus the ever-increasing chance that all of that is wrong creates a trading opportunity, right? And for me, looking at that, it would be to fade 2-year note futures into that lack of an accurate forecast or an accurate amount of positioning in the Fed funds futures for when those cuts would happen and the depth of those cuts. So that would be an example of using market implied probabilities to set up a trade where you have a thesis that may contradict what the market is expecting. And if that thesis plays out, it could be quite lucrative for that trade setup. So that's what I'm looking at there when I'm looking at Fed funds futures. I'm looking at the market implied probabilities or expectations going into this year, and really late last year. What I saw was egregious amounts of dovish expectations versus the reality. Why would the Fed need to cut if the market's pushing to all-time highs? Housing prices are near all-time highs. Bitcoin is making like 2.5-year highs. You've got prices rising in CPI and ISM services, PMI. Everything says that there's no reason for the Fed to cut anytime soon. So my thought on that would be that, market implied probabilities, if you have a strong thesis that is contrary to those market implied probabilities, that's where a trade setup may come in. Let me know if that's helpful. My personal opinion is it would be a mistake for the Fed cut here. There are long and variable lags, but there's also, still excess liquidity in the pipeline. When Bitcoin's bid this much over 50,000, that's not telling us it's time for Fed cuts. I think that financial conditions easing the most they ever have in history during November was the market front-running the expectation of the Fed cutting and, in effect, providing those cuts. The market eased liquidity such that the Fed may as well have cut by 50 bips during November, if not 75. And they may as well tapered QT because that was the net impact. Similarly, over the course of 2023, there were all kinds of countervailing impacts to the Fed's tightening. One of them was, the lack of debt issuance from the U.S. government all the way up to June. That's net stimulative. That was counter impacting quantitative tightening because there was a lack of liquidity being pulled out of markets to buy those issuances that weren't happening, particularly on the longer end. Then as we got beyond that period, we saw a big pickup in government spending on infrastructure and construction as a part of the CHIPS and Science Act and Inflation Reduction Act, which again juiced bank reserves because you got all those bills being paid by the government, and that offset QT and rate hiking. So I would argue on the other side of this, there really hasn't been that much of a hiking cycle that's been impacting many parts of the market. In fact, if you look at Apple or Google or Microsoft or other companies that have huge amounts of cash, they refinanced their debt around the COVID rate lows. And now they have a bunch of their cash parked in bills, so they're actually earning net interest income. So the tightening for them has been net beneficial. Similarly, when we look at speculators, they've moved from participating a lot in futures and shares to options and in shorter and shorter time frames. So you've seen that offset the effect of higher margin costs because they've just shifted where speculation's happening. So I'm going to pivot entirely to foreign policy for a second, just because I had an interesting exchange on our Discord. I mentioned that the Pentagon has been planning to go to war against Iran for the better part of over 2 decades, and that's because there's actual war plans that were drawn up even before the unfortunate events of 9/11 to attack Iran. Now, we've had tensions with this country for, as it was pointed out, over a half century, and that's true. And those tensions happened because the U.S. and U.K. went ahead and decided it was in their best interest to basically engage in a coup d'etat against the democratically elected president of Iran, Mossadegh, during a time where he wanted to redistribute oil revenues to the people, God forbid. And so because those oil revenues were going to what would later become British Petroleum, that irked the crown, and that caused this sort of revulsion. And the irony is, even after ejecting Mossadegh and putting in the Shah in power, and that sort of reign of terror that followed, that oil money never went back to England. So, yeah, you could say the West has been intervening in Iran for 70 plus years. You can go back quite a bit further than 50 years. But when you talk about legitimate war plans that have been drafted by the DoD, where they actually want to have troops on the ground, that's something that's a little more recent. That's been happening since really 2000. And that's a pretty big geopolitical threat. If that were ever to play out, I think that would be a huge problem. And we can see, there's been passive meddling for quite a long time. Both countries back and forth. And don't get me wrong, I don't think highly of the Iranian regime. I think they're terrible. One of the worst governments in the entire world. But no one's right when everyone's wrong. And that's sort of the situation that's led us to the current path that we have with foreign policy and a potential conflict. Where we've been fighting proxy wars against Iran for a long time. Look at Yemen. The Saudi Arabia, backed by the U.S., fighting Iranian-backed Houthi rebels for years and years. Everyone lost that. There was no winners in that battle. But, I think that the reality of a more direct conflict between Iran, Israel, United States it's becoming more realistic in the year or two, unfortunately. Yeah, Trading Donkey, I would agree. We have not felt the true effects of rate hikes in many parts of the economy. There are some parts that are feeling it. The bottom 50% of income earners are feeling it because they've been putting more and more of necessary expenses on credit cards. So for that same contingent, we are seeing their delinquency rates rise. Nothing alarming, but it is rising. We see that in subprime auto debt. Those delinquencies are rising to alarming levels. Back to great financial crisis levels of delinquencies in subprime auto debt. Not terribly surprising given the price of cars here and the price of owning them, insurance, everything. But in terms of, those rate hikes being felt by like the broader economy, outside of small and medium-sized businesses where they have revolvers that reset to those rising rates, you're right. Those hikes have not necessarily been well felt. But that would also tell me that we actually need more time for that to play out before the Fed cuts. I think it would be a mistake for the Fed to cut in a world of growing demand and a lack of supply in a lot of key areas. I think it would actually rekindle inflation in a pretty significant way. And so that would be my concern. If the Fed cuts too early and too aggressively and other central banks follow, I think we're kind of back at square one. Because a lot of the issues that led to inflation on the supply side have only half been worked out. And now we're hearing that there is a new national security threat that is, quote, highly concerning and destabilizing and being attributed to a new Russian capability. And I don't know exactly what all is being implied by this. I would imagine this is either a cyber or kinetic capability. If it's a cyber capability, it could be a way of taking down key parts of U.S. infrastructure. If it's a kinetic capability, it could be a way to evade missile defense systems or otherwise, although the hypersonic missiles seem to accomplish that. Still seeing resistance over there at VWAP. We have built over the point of control here, but there's just no volume here. We're in the lunch hour. As I discussed earlier, when you get in the lunch hour, things tend to thin out. You can see that like pretty much after 12, volume got real thin. You can see that below on the volume chart. You can also see that on main screen with the smaller size of transactional activity in those bubbles.
Never took your side, never cursed your name. I keep my lips shut tight until you go.
All right, so let's take a look around some of these markets. NASDAQ's pushing above the point of control and VWAP here with some decent volume. You can see that volume bar down here as well as this big green bubble. There was a little bit of passive selling into that iceberg above, and you can see on the subchart dipping, and the iceberg radial down at negative 138. Russell, similar look as the NASDAQ, building above the point of control in VWAP. So looking comparatively more bullish than the S&P, which is now challenging VWAP from below. Did see some iceberg selling into that as well. Seeing more relief in rates here. That's probably one of the reasons we're seeing the NASDAQ and Russell catch a stronger bid in the S&P, because they tend to be a little bit more rate sensitive. 10-year note contract seeing more buying here. And oil falling, which helps to bring rates lower as well. So those are two elements that are supportive of the market here. Let's see if the S&P can break above VWAP and follow its peers.
RAYA resuming, Romeo Alpha Yankee Alpha. $1.44 now on RAYA, Romeo Alpha Yankee Alpha. BKKT filing an update on risk factor related to going concern. There's an updated risk factor that addresses company's ability to continue as a going concern. It meant a substantial doubt about the company to continue for the next 12 months without raising capital.
Alrighty. Well, that's not good news for BKKT, is it? It may not be a going concern. Stock is $1 today. $1.02, up 5%. At one point, it was trading at $42.52 back in the heydays of late 2021 during what could only be described as a hyper bubble. Yeah, one thing I will say about this year, where more of the human population on Earth are selecting their leadership at elections, however fair or not fair they may be, depending on the country, there's going to be more propaganda this year than you've ever experienced before in human history. All over the place. Foreign policy, economics, you name it, social issues. There's just going to be a crescendo, a deafening chorus of nonsense. So if you've ever had to tune out the noise, if you've ever felt like it was a good time to not pay too much attention to that sort of stuff, it's right now. Right now is a really good time to focus on signal and tune out a lot of the politics and then stories that are disguised as being political that aren't. Still just struggling here at VWAP. Seeing a little bit of volume building. NASDAQ comparatively looks quite a bit better than the S&P here. Above VWAP and the point of control. Making higher highs. Similar look with the Russell. But SPOOs aren't getting off the mat quite yet. I have a feeling some of that has to do with options expiration. Some of these key levels that are providing resistance. Nevertheless, we do see liquidity building above a bit here. And we do see some resting liquidity also growing in size right there at the point of control, which aligns with that level where we saw participants liking to transact right around 49.85, similar to the level we're at now with VWAP. And Russell continuing to push higher here. Crude continuing to move lower. That's probably giving rates a bit more of a bid. Here we go. You got rates moving down more on the 10-year, pushing higher. There's usually a pretty good inverse relationship between the 10-year price and the crude price, and we're certainly seeing that play out today. Gold getting a little bit more of a pop as rates come down. Should also be helping the euro here. It's also building from its lows for similar reasons. Of course, all this is great for the Russell. Russell has so many unprofitable companies that they're quite sensitive to rising rates. We go back to the S&P. We'll just zoom out a little bit. We can see again interest building at that most active call strike, which would be SPX 5000. It's about ES 5017 when you adjust for the delta between the futures and spot. And someone points out that fixed strike vol is going up on these moves up. Yeah, that's generally not a great sign. Typically a sign of a market that's much more concerned about missing upside than hedging downside. Tends to be, when you see a strong positive correlation between vol and S&P pricing, tends to be around a turning point in the market. Not saying that that is what we're seeing, but it can be. And if we look back at the technical analysis I did earlier on ES, we could say, breaking below the 20, that trend line and that key area, the volume profile, if all three of those things happened, I'd be a little more concerned about downside risk appreciating. Interesting dichotomy here, though. Russell continuing to build as S&P just can't really seem to get off the mat and push higher. Granted, we're about 20 handles off the lows. Some unusually sized call buying in GLD.
Rock
GCI
trading
Alpha
ticker
Concern doing a
NOV.
bit lower now. Alpha Charlie India.
185 strike for March 15th, about 240,000 in premium there on GLD.
Colorado Attorney General Phil Weiser files lawsuit to block proposed Kroger-Albertsons merger. That's KR and ACI.
Just take a look around here. There's the Russell on screen. We've got the NASDAQ on screen. Again, kind of consolidating, building some acceptance here above VWAP and the point of control. Overall, the Russell and the NASDAQ looking comparatively better than the S&P 500. Rates continuing to drop on the 10, which should be more supportive. But again, we need to see S&P break above VWAP and Gamma 4 and build acceptance. We do see more resting offers building above us here. Got about 3 hours left in the trading day. Now we're finally seeing another kind of upside pop above the point of control on the S&P 500 futures. Some selling into that. We had a 1,700 lot iceberg sale right at that level. You know, if you enjoy watching paint dry, then I've got the trading vehicle for you. It is the S&P 500 futures. NASDAQ chopping along, a little more volatile than the SPOOs, but just very sideways action here. Russell is really the one that looks the best of all three. Crude continuing to kind of stair step down, lower highs, lower lows, to find intraday downtrend in the microstructure. Rates continue to move lower as the 10-year is bid, and gold has pushed well off its lows. Let's look at where it was earlier today. We could see it just broke below 2,000s, up about $10 above those lows, with a really large resting offer just above here. This is such a thinly traded contract, and when you see a resting offer this large above, it could act a bit like gravity, pull gold maybe a couple bucks higher, $2 to $5 higher.
Final trades on CNBC, LDOS Lados, PGR Progressive, DIS Disney, NEE Nextera Energy. Final trades on CNBC.
ECB's Nagel says inflation is going in the right direction, but we're not there yet.
Block trade and ticker, AKRO.
Oh, would you look at that? All I need to do was step away, and now we get some actual price action in the market. So we see the S&P continuing to challenge Gamma 4, a little bit of a look above there. We'll see if we can build on that. And we are seeing some increased volume in this buy-side participation, enough to drag the point of control higher here. We are pressing above VWAP, continuing to challenge that Gamma 4 level, which is, as of now, the fourth largest area of gross gamma positioning on the S&P 500 options chain. So it ends up being a pretty pivotal level, one worth watching, of course. And yes, I am a little quiet here. I'm just watching this price action, posting a little bit about what my partner Horst was talking about with NVIDIA and its gamma profile. We actually built a tool recently that allows full profiling of every optionable stock and ETF for the full chain, and I'll be doing 0 DTE gamma chains next for those, as well as volume. So pretty cool functionality on our Discord. You can use the command !gamma and then the symbol of the stock or ETF in all caps in the bot queries room. And that data is compiled in near time. So as soon as you do the command, the bot is pulling the data from CBOE, processing it, and creating the graph. So there's like very, very minimal delay. So someone asks in the questions room about the iceberg radials and what they mean. So when you see, like as his example pictures show, a 1,120 positive reading, that means over the last 30 minutes that there was 1,120 icebergs on the buy side in excess of the sell side. The opposite is true if you see that negative print, like negative 1070. Let me know if that helps. We are seeing a pull here now in the S&P. We just had the point of control dragged higher by that consolidation, only to push right below it into a key level of resting liquidity. Rejected again at Gamma 4. This is a formidable area of resistance and has everything to do with options positioning in the S&P. And now the point of control pulled right back down to where it was before at 49.85. That's the real-time hours point of control. So I'm just really looking at the cash session for that volume. Regular trading hours are where a lot of the transacting is happening. So I tend to focus more on that now. Someone just bought 320,000 of MicroStrategy puts for this Friday, targeting 750. Boy, what a short squeeze that's been on the crypto rally. There's so much short positioning against these crypto names. They tend to be really good trading vehicles for squeezes when crypto has a bid. Mara is another one. We got into that trade again at Traderade. This is the second time. The first time we had a near triple on it in a month. And, you know, I built a model that's been back-tested, identifying some of the factors that can lead to these squeezes. And it's been good. I'm not going to say it's got a perfect hit rate because nothing does. But it's been quite good in this environment because hedge funds are so irresponsibly short some of these crowded names. So you get these episodic catalysts that build an incredible squeeze. And when those squeezes happen, they play out quickly and they're pretty violent to the upside. So it can be an interesting trading opportunity. It's certainly one of my favorite short-term trades. And I do these in small size. This is literally degenerate gambling when you're playing short squeezes. Yes, it's tactical. Yes, I have a system that I employ that manages my risk. But in terms of like the way these things move, they may as well be an altcoin. So when I'm deciding the size of my position in something, I determine it based on the inherent volatility of the instrument. I wrote an article on Traderade. Y'all are welcome to check out one of our educational articles about volatility and how I measure it and how I look at that in terms of figuring out position size. Because if you think about it, if you're trading something that's really, really volatile, what's the last thing you want to do? You don't want to get into that thing in full size, like you know, full port long, something that's got like a crazy beta. That would be irresponsible. You could get absolutely destroyed, particularly if you put margin into that trade. On the other side, however, if you're sizing your trades based on the volatility of what you're trading, like much smaller size for natural gas than S&P, for example, then you can control your risk. You can have more favorable stop positioning, because if you're trading natural gas, and God forbid if you're doing it right now because you might be getting killed if you're not on the short side, but if you're trading things like that, you need to make sure that you have wider stops because they're freaking volatile. You'll get stopped out left and right, which means, again, like if you're trying to manage your loss, you're trying to make sure no single loss is more than 1% of your portfolio, or at most, let's say 2%, then you need to make sure that position size is such that if you hit your max risk and get stopped out, that you're not losing more than that amount of capital, which means no irresponsibly leveraged gambling.
Shortly expecting the results.
I know
of
that's not
Reverse
fun.
Operation.
I know there are folks that love the idea of risking their entire account on a single options play or something like that. But the reality is that's not trading. That is actual gambling, and it's unlikely that one will be consistent in doing that. It's also unlikely that they even fully appreciate the risks that they're taking to such an extent that they can have a repeatable trading system that doesn't eventually blow them up. That's sort of the harsh reality. Gamma 4 is the 4th largest area of gross gamma positioning, and it is acting as a strong area of resistance. So we can see that price action today has been seeing that area as an area of resistance. It was earlier an area of support. And I think when support becomes resistance, it makes that resistance even more important. We can also see Gamma 4 is just right around VWAP, which I don't think is much of a coincidence here. We are in OPEX week. There's a lot of position rolling happening here. Let's see how the NASDAQ's doing. So NASDAQ got pulled below its point of control and VWAP. VWAP acted as overhead resistance, and then there was a further rejection. So we made a lower high, lower low, another lower low. We'll see if this becomes a lower high. But this seems like microstructure trend going from consolidation to drawing down so far. Russell's still resilient here, though. Look at the Russell bouncing off the point of control. This is definitely showing strength here among weakness elsewhere. Well, right now, we're just at gamma neutrality, basically. I mean, we're just, 12 points above the gamma flip? So in terms of dealer hedging flows, from that perspective, they're pretty flat. When you're in positive gamma, they're buying dips and selling rips. But when you're barely in positive gamma, as we are right now, that flow is subdued. So I would contextualize, based on our naive model, that the flip level is something to watch for how dealer flows may adjust. Gamma 4 is the 4th largest area of gross positioning, so it can act a bit like a magnet, as well as support or resistance with respect to where price is in relation to it. And in terms of dealer hedging, just one other thing I want to say is that dealers tend to hedge in near time, sometimes in real time, depending on how advanced their capabilities are. So like as soon as contracts are being sold, they're doing that hedging like at that very moment or right afterwards. And then as deltas change, they will adjust their hedging in near time as well. Yeah, this is just a pretty slow and boring tape overall today. NASDAQ and S&P back in sort of questionable territory. Russell rolling over a bit, but overall from its recent lows, the strongest of the pack here. Crude oil building a base just below 77. My key pivot for crude, for what it's worth for those that are watching, is 76. I feel like above there, buyers have the edge. Below there, and sellers start to have more of an edge. Rates continuing to move a bit lower, but a bit sideways over, say, the last 45 minutes or so. But overall, that path of rates today has been lower. As you can see, 10-year note futures really bid over the past 3 hours, right? So that's continuing. Gold hasn't yet gotten up to that huge resting offer. I say huge because, again, this is a contract that sells with an order book depth of about 6,000. It's not much, right? So 100 is actually a big deal in gold. And you see that amount of resting liquidity. Yeah, I agree with what you're saying there, Trading Donkey. What he said is look above yesterday's range and acceptance back in suggests move to the opposite end. As someone asked, do I think yesterday's inflation triggered some vol buying and that continues today? Rates are lower, yet stocks fail to bounce. Great question. So it is VIXpiration, which means you have, a lot of rolling of VIX products going into today. And that tends to be a bit of a catalyst for downside, particularly post-VIXpiration, like Thursday on. You're entering that window of weakness, or window where there's not the same level of passive flows from dealers reducing hedges that were short S&P futures. So that period of time is typically liquidity positive. I think that today, we're coming off of that selling from CPI. I think some people were a bit rattled. We saw Fed expectations change. Now the first cut is being priced in for July. And it's still a bit of a mystery as to why, there's this pricing in of cuts in a market where we're near all-time highs, housing prices near all-time highs, crypto's at 2.5-year highs, the job market is quite tight. So I'd say that there's still probably some recalibration underneath the surface here. You're absolutely right to say that lower rates should bring a bid back to stocks, and to some degree they did. That bid happened overnight, and maybe rates are catching up a little bit with that bid now. But I do think you're making an important point. Like, what happens with stocks if rates continue to move down from the recent highs? I would expect that they would get a bid, and the opposite if rates start to build and move higher from here. Yes, that's a good point. Rates were running for several weeks while stocks were pushing higher, and then all of a sudden they started to matter again. One thing that we've seen actually over that last period of time where certain parts of the market got bid up in excess of where rates were implying they should go, places like home builders, biotech, the Russell 2000. I did a whole segment on this in Navigating the Markets, so you can check out that video on my YouTube. I also uploaded it to Twitter. Might be helpful to contextualize some of the themes that I'm talking about today. Navigating the Markets is a segment that I do every week on Traderade, and I share this week's to everyone as a courtesy to kind of show some of the work that I'm doing. But that all being said, I'm going to hop off mic for a bit here. I hope this has been helpful to all those who have been watching. If you enjoy this stuff, I do it more regularly on our Discord server. And you can always check us out at Traderade.com. You can also check out Bookmap. You can get a 40% discount up to that much by visiting Traderade.com/bookmap. And if you like the SPX options visualizer, check out Traderade.com/SPX. It should redirect you to the Bookmap Marketplace, where you can grab a copy for yourself. Thanks everyone for tuning in. I will catch up with you soon.